Good evening. My name is Jackie Knight. I'm the Corporate Training Director for STC. Thank you for joining me this evening for our educational webinar entitled Real Estate Investing in Your Self-Directed IRA. Before I get started, I do need to just go through a few items about STC. We are a retirement plan administrator, so we do not provide legal, tax, or investment advice. And we also don't represent or sell any securities or investments of any kind. We're not a registered investment advisor, nor do we represent or endorse any particular investment opportunities. And I will be talking particularly about real estate investing in this webinar, but we don't represent or endorse any particular investment opportunities. And we do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. This evening's webinar is going to cover some basic information about self-directed retirement accounts. I'm going to go through the benefits of self-directing your funds and guidelines that need to be followed in self-direction and, in fact, all retirement investing. Some details about STC and the services that we offer our clients, and then we're going to go specifically into investing in real estate, choosing and funding an investment, and talk about some related topics that relate to real estate investing. So to get started, let's talk about a definition for self-directed retirement plan. When that terminology is used, we mean that you are working with a company, an entity that permits you to own any type of allowable asset in your account. So that includes things like real estate or loans, making loans from your retirement account, anything that is allowed by the IRS rules and regulations. It also means that you are going to manage your retirement plan's investments. You're going to make the decisions that relate to those investments. For example, if you choose to purchase a piece of real estate in your retirement account, you would be the one that would decide if you were going to renovate that property, hold it, rent it, down the road sell it. You would decide the rental rate, the selling price. You would make the decisions related to that investment. So basically, you have control. You have control over the decision-making choices and decisions related to the investments that you hold in your retirement account. Now, there are a number of different types of retirement plans. Two that may be most familiar to you are the traditional and Roth IRAs, individual retirement accounts or arrangements. You can make contributions into these plans from your earnings. The difference between the two plans, they both have the same contribution limits, and actually those limits are going to be going up in 2023, but I'll talk about 2022 since that's the year that you'd be making a contribution for before you pay your taxes next year. So in 2022, traditional and Roth IRAs both have a contribution allowance of $6,000. And if you're 50 years or older, you can add $1,000 to that as a catch-up for a total of $7,000. The difference between these two plans is that a Roth IRA is a post-tax plan. So your contribution is made post-tax. You actually pay taxes on the contribution amount. But then a Roth basically earns tax-free as long as you hold the plan for 5 years before you begin taking any distributions and you have reached defined retirement age of 59 and a half. When you take a distribution at that point in time, that distribution will not be included in your taxable income. So a Roth IRA, unlike other retirement plans, does have the potential to earn tax-free. A traditional IRA's contributions are pre-tax, so they're deducted from your taxable income in the year that you make that contribution, the year that you make that contribution for, and then you'll pay taxes when you begin taking qualified distributions from a traditional IRA. So a common plan, many people have these plans. A SEP plan is a simplified employee pension plan. This is sometimes plan that sole proprietors use for their businesses. Sometimes small companies, you can make an employer and an employee contribution into a SEP. And for 2022, the maximum SEP contribution, so this would be contributing monies from the earnings that the SEP plan is on, it's a business type of plan, are limited to $61,000, and that is going to go up in 2023 as well. A simple plan, a savings incentive match plan, this is another type of deferral plan. Sometimes used by, I've seen it used by sole proprietors, by partnerships. So just a different type of plan with different requirements. For 2022, the maximum contribution is $14,000, also going up in 2023. Now, I've just brought out onto your screen 4 different types of plans that say former employer. So a 401k plan is a for-profit corporate type of plan. 403Bs are used oftentimes by charitable organizations or nonprofits. A TSA is a tax-sheltered annuity. A TSP is a thrift savings plan. If you formerly worked for an employer and participated in one of these types of plans, then you can move the monies out of that plan into a plan that you qualify for. For example, a traditional IRA, or perhaps you have a business, you could transfer it into a SEP. So something to keep in mind, if you are currently employed, then you will need to go to your plan administrator, your employer's plan administrator, to determine if you are eligible to move any money out of that plan into another type of plan that you could self-direct. And the last plan I'll talk about is a solo 401k plan. This is a newer plan that was developed so that sole proprietors, those are people who are in business by themselves, for themselves, by themselves, really the only employee, would have the same benefits in a retirement savings plan as a 401k. So it has some different types of features. There is a loan provision in a solo 401k that can be very helpful for a small business owner. There is also the opportunity to have a Roth provision where monies would earn tax-free with a solo 401k plan. So if you're interested in that type of a plan, it does have to be set up. A solo 401k plan would need to be set up by December 31st. So you'd be on a tight time frame to get that open for this year. But just something to think about if you are a sole proprietor. A lot of self-employed sole proprietors might choose that type of plan. But something to think about if you are interested. And if you're interested in any of these types of plans and need a little more information, please do speak to your tax accountant. I can give you some general information if you would like that as well. Now, I want to talk just a little bit about why you might want to self-direct. And probably one of the primary benefits is that you're not restricted to stocks, bonds, mutual funds. You can diversify into different types of assets that don't directly correlate to the stock market. So things like real estate, mortgages and notes. You can actually purchase a mortgage, real estate-backed mortgage. You can make loans to others. You can invest in private businesses. So you can really diversify into different types of assets, and you don't have all of your retirement funds in a single type of asset, which can be very beneficial. Most financial planners think that is the best way to diversify your assets. The other benefit is that, as I mentioned earlier, you are going to choose the assets that you want to hold, and you're going to control those investments and the transactions related to those investments. Now, with real estate investing, you have an additional benefit in that you can actually increase the buying power of the funds that you have in your retirement account by using leverage. Your retirement account can actually get a loan to purchase real estate that you hold in your retirement account. I am going to talk a little bit more about that specifically because it does require a particular type of loan. It must be a non-recourse loan. So we'll talk a little bit more about that on a future slide. But these are some of the reasons that you might want to consider self-direction. Now, with all retirement account investing, there are rules and guidelines that must be followed. These are set up by the IRS or the Department of Labor, depending on what type of plan you have. And some of these guidelines are administrative requirements. There must be an annual valuation made for your account each year and an annual report sent to the IRS, a Form 5498. Books and records of all of your investments and your transactions must be maintained. There may be state filings that are necessary depending on what you own and what state you own it in. And there is the potential for tax returns. Not with most retirement account investments, but there are some cases where that can come into play. And I will also mention that. We'll talk a little bit more about that. Some additional guidelines are that there are some things you may not invest in. They are prohibited assets. One of those is life insurance contracts, with one exception. If your plan is a solo 401k plan, then a life insurance contract is a valid investment for that type of plan. Additionally, other prohibited assets are collectibles. So this would be precious works of art, rugs, Persian rugs. I've seen some people who'd like to own those. Stamps, stamp collections, coin collections. Now, this does not include precious metals, and there are some precious metal coins that are permissible and may be held in a retirement account, but we're talking about like a collection of rare coins, for example. Those are prohibited assets. Additionally, there are types of transactions that are prohibited. Transactions do need to be for the benefit of your retirement plan. So you cannot personally borrow money from your retirement plan. That is prohibited. You also cannot pledge your plan assets, the money in your retirement plan, to secure a personal loan. You cannot utilize your personal credit or guarantee to obtain a loan for your retirement plan. Now, I mentioned you can get a loan. You just can't personally guarantee that loan. You also cannot benefit any disqualified person. So let's talk a little bit about who these disqualified persons are that you cannot benefit with a transaction. And you'll see the first person on the list is you. You and your retirement account are distinct entities, and your retirement account cannot do a direct transaction with you. So let me give you an example of what that would be. Let's say you personally own a vacational rental property in Myrtle Beach, South Carolina. Your retirement plan cannot purchase that rental property from you. That would violate the disqualified person prohibited. It'd be a prohibited transaction because you would be doing a transaction with a disqualified person. If you are married, this also includes your spouse. Your spouse is also a disqualified person to your retirement plan. There are other family members who are also disqualified. Your ascendants, so that's your parents, your grandparents, your great-grandparents on up the line, and your descendants, your children, your grandchildren, your great-grandchildren, on down the line, are all disqualified persons. However, lateral family members are not disqualified. So when I say lateral family members, I mean people like your brothers and your sisters, your aunts and your uncles, your nieces and your nephews, your cousins. None of them are disqualified persons. So back to that rental property that you own, your father could not buy it from you, or let's say your father owned it. Your retirement account could not purchase it from your father. If your daughter owned it, your retirement account could not purchase it from your daughter. But if your sister owned it or your uncle owned it, your retirement account could purchase it from them because they're lateral family members. So just some things to keep in mind. There are also two entities that are disqualified persons to your retirement account. That's any company if you're the majority shareholder, or any company if you're an officer, a director, or a highly compensated employee of that company. So just some things to keep in mind. We do not expect our clients to know all the rules and the guidelines. That is what our client services department helps you with, but just to get you thinking about kinds of transactions you might be able to engage in and who the parties would be that you might be partnering with or purchasing from to help you get started with that. I will go through now the services that STC offers. We are a full service, self-directed administrator. So we set up a retirement account LLC structure for each of our clients' account, and I'm going to tell you why we use that particular type of setup. We have CPAs and attorneys available to answer your technical questions, and we can also talk with your advisors if you would like us to do that. You can arrange for that. If your tax accountant needs some help or understanding of a transaction, we can give you some help with that. We offer unlimited guidance on transaction compliance because we are the experts, so we'll review your transaction and make sure that it complies with the IRS rules. We'll handle all the back office support. So by that I mean all the maintenance of the financial statements. We actually make available to you quarterly LLC financial statements for your account, so you can see exactly the transactions and the assets that you hold. We'll supervise the regulatory reporting, and we will oversee the annual valuation. So basically, our approach is to provide you all of the administrative and transaction guideline help that you need so that you can really focus on finding the best investments for your retirement plan. Now back to the LLC structure that we use for each of our clients. We do this because it offers you the maximum flexibility in structuring complex transactions. With our setup, you can actually partner with otherwise disqualified persons, and I'll tell you about that in a moment, and your retirement account can get a loan. Your parties, if you have multiple parties, can potentially earn different amounts from the investment. So having this LLC structure gives you a lot of flexibility with your transactions. It does provide an additional layer of asset protection. Now, I will say that this is not a generic business LLC. It is a specialized LLC that our operations department creates just for your retirement account. So its operating agreement and its articles of organization are designed to be owned by a retirement account. So it's a very specialized LLC. It does give you checkbook control over your retirement account funds. And the reason that's important is because sometimes, good investments can go very quickly. You need to be able to move on them right away, be able to close on an opportunity. So what we do, you'll notice checkbook control is in quotes. We don't actually give our clients the checkbook for their retirement account. And we do that purposefully. We know that there is the potential, if you have the checkbook, to engage in a prohibited transaction unknowingly. And the penalties for doing that can be severe, up to even forfeiting your retirement account and it suddenly all becoming taxable to you. So what we do instead is we are the administrative co-manager of this LLC. And that permits us to review your transactions and the transaction documents to make sure that they're in compliance with the IRS rules. And then we can immediately fund the transaction once we see that. So once your account is set up, you would send us documentation, we would review it, and then we would fund the transaction. If there was anything questionable about the transaction, we would talk with you about that to make sure that we could get that straightened out so that it didn't violate any of the rules. So it's protected checkbook control. You have our protection of expertise, but you still have that immediate response to a seller's opportunity. Using the LLC also simplifies asset titling. In a real estate transaction, it can be challenging if you had to send documents to a corporate office where they had to find their way to the correct person's desk in order for them to review the documents and sign off on closing papers. With our LLC structure, you as the retirement account owner can actually go to the closing. You can sign the closing documents on behalf of your retirement account. So we have that all set up in the structure so that you can do that. The structure also makes it straightforward to pool or partner with other funding sources to co-own an investment. And I'll talk a little bit more about that in a moment too. Now, I do want to mention the different types of investments that you can choose with a self-directed account. I've just brought out onto your screen different types of real estate investments: single and multifamily homes, vacation property, raw land, building lots, commercial buildings, real estate syndications, where you might be partnering with others to co-own some type of real estate investment, and tax liens, which are actually not a real estate investment in themselves, but if the lien wasn't paid off, you could foreclose on it and potentially own real estate. So there are types of real estate investments. You can also invest in mortgages and loans, private business investments, operating businesses, and precious metals. And you can invest in the Forex market, the foreign currency market, options, futures, and of course you could always have a portion of your account in stocks and bonds and mutual funds. So here you can see how you can have such a diverse group of assets in your retirement plan. Let's walk through the process of investing your funds in real estate with STC, with an STC account. So what you can do first, and this is entirely optional, but I highly recommend it, is you request our client services department to review your transaction and the structure of the transaction in advance of going to closing. That way, if they see anything that's questionable or that is a problem, you can get that taken care of before closing date. Then you request transfer of funds. So this is an actual form that we have that you would receive as a client, and you would request our client services department to purchase a particular investment for you. Client services reviews that document and all of the backup documents for it. They review the transaction, and when they see that it is good to go, it's all structured properly and in compliance, then they would process that transfer request. The monies would be sent from the LLC bank account to the seller, and then you would own that property, that investment in your retirement account. Now, with an STC account, you do have 24-hour turnaround time. So if you send us documents by 2 p.m. Eastern Time, we can same day fund that transaction. If it comes after 2 p.m., then it might be next business day, but you can very quickly get the money to the seller. Now let's talk particularly about purchasing real estate. Now it will be your job as the retirement account owner to locate the property that you want to invest in and to make an offer on that property. Now, we can't provide any type of recommendations about whether or not the property is a good investment. We can't give you any rental advice or resale guidance. That is something you would have to do on your own or get another advisor to assist you with. The offer must be in the name of the buyer. Now, in this case, it's going to be your IRA LLC name, and you'll choose that when you're setting up the account with us. Now, if your retirement account is the only buyer, then that's the only name that will be listed on the offer. If you're actually co-purchasing, in other words, you and someone else are buying the property together, then both of those names would need to be on the document. Now, if you need an escrow deposit, and that's often the case, then what our client services department will need is a copy of the contract that is showing the IRA LLC as the buyer, and then a completed signed request to transfer funds form. That's our in-house document that directs us and gives us all of the pertinent information in order to purchase the asset for your retirement account. Now, if you're going to closing, we will need a copy of the estimated HUD or the settlement statement showing the IRA LLC as the buyer and that completed form. And we do ask, again, you see on the screen, by 2 p.m. We request the paperwork by the business day before closing, and really it's best if you can give us some additional time just in case there is some issue with how the documents are titled, etc. If the funds aren't in the buyer's name, they're not listed properly, for example, a down payment that didn't come from the IRA, then we're not going to be able to fund that transaction. That will need to be corrected. So I always think it's great to talk with client services. They're happy to help you. You can discuss the transaction with them in advance. Make sure that everything is all lined up. Now, typically, the disbursement of the funds for a real estate purchase do need to be guaranteed funds. So our clients usually request us to issue a wire transfer. You can request a bank official check. So it's going to depend on the seller, what type of payment they're going to require. And then once again, you can go to closing and you can sign all the closing documents on behalf of your retirement account. What you would do is you would send a copy of those closing documents, the signed documents, send us a copy, and you can keep the original. Again, you do have the option of using borrowed funds. It must be a non-recourse loan, which I'm going to give you some details about what that means in a moment. But it does need to be a non-recourse loan. And if you use borrowed funds, then this is a possibility where a tax implication may occur. UBIT, unrelated business income tax, a subset of which is UDFI, unrelated debt financed income, could come into play. And I will give you some more details on that. Now, back to using borrowed funds, you can do that. There can be a case where you can personally partner using personal funds and retirement account funds to co-own an investment. That can be done if you do that partnership at the inception of the transaction. If you are partnering with yourself, if your retirement account is partnering with personal fund money, you cannot personally guarantee a loan for your portion. That also would need to be a non-recourse loan. So if you're thinking of getting a loan and you have multiple purchasers to the transaction, you will want to discuss that with our client services department so they can make sure that you understand how to structure that properly and what kind of loans can be used. If the IRA LLC is the borrower, then the IRA makes the loan payment. So whichever purchaser has the loan, that's the purchaser that makes the loan payment. You can do some very interesting transactions, but they do need to follow the guidelines, and we are happy to help our clients with those sophisticated types of transactions. Now, I mentioned that you could partner with others, and you can actually partner with anyone, including otherwise disqualified persons at the inception of a transaction. So let me give you an example. Let's say your retirement account, and your spouse's retirement account want to partner and co-own a piece of real estate. You can do that. If you do that, the ownership percentages can never change. So all of the property expenses for that property that you and your spouse's retirement accounts co-own, all the property expenses have to be paid based on your ownership. So if you own 70% and your spouse owns 30%, every expense needs to be paid by your retirement account 70% and your spouse's retirement account 30%. So that those percentages always have to be the same. The same with revenues. If that's a rental property that's earning rental income and your retirement account owns 70% of the property, then your retirement account receives 70% of the rental income, and your spouse's retirement account receives 30%. That always has to stay the same when you have disqualified persons involved. Now, we have some very sophisticated real estate investors in their retirement account, excuse me, who like to set up an individual LLC for each property. And you can set up a sub LLC under your IRA LLC to own the property. You can do that. But all of the rules relating to retirement accounts still must be followed. So if you decided you wanted to do that, we, our client services department, would want to see the operating agreement for this sub LLC that states clearly who the owners of the sub LLC are and the amount that they're contributing and their percentage of ownership. And we will expect that those percentages of ownership will match up with the amounts invested. And it's actually a requirement if the owners are disqualified parties to each other. So there are some rules that have to be followed, and if you were to decide that you wanted to do this, you certainly can, but you would need to discuss that with our operating and client services department, and they could help you understand how to make sure that the rules are followed. And you just have to keep in mind that even with the sub LLC, all the same IRS and ERISA guidelines apply. So the IRA holder or a disqualified party can't guarantee any loans with the sub LLC. All the same rules apply. Doesn't matter that it's in the sub LLC. Now, disqualified persons, so again, that's you, your spouse, your ascendants, your descendants, cannot do any rehab or repairs to a property, and also cannot be a tenant of that property. They can't be a buyer, in other words, you can't sell it to them, or they can't be a seller. You can't buy it from them. So you do have to remember that. Now, if you are a licensed real estate agent, we do encourage our clients who are licensed real estate agents not to be involved with any transaction that involves their IRA, because that could trigger this whole disqualified, prohibited transaction. So it really is difficult to have anything to do other than choosing the property. You can't, sell it to yourself, buy it from yourself, any of those things. So you do just want to be cautious and make sure that you maintain, the arm's length transaction distance between you and your retirement account. Now, I mentioned that you can partner with others to co-own an investment. And I'm going to bring up onto your screen 3 parties that can otherwise be disqualified. Yourself, in other words, personal money that you have separate from your retirement account, your spouse, your family members, ascendants and descendants, You can partner with them as long as that partnership is at the inception of the purchase transaction, because that is when each of you is actually purchasing from the seller. You're not purchasing from each other. So you can partner with these people if the transaction is structured properly. And of course, you could partner with other investing colleagues, LLCs, investment syndications. All of those are potential partners for co-owning an investment in your retirement account. So let me just show you a schematic of our retirement plan structure. You'll see on the upper left, your current custodian. You decide that you want to open an account with STC. You would complete some documents that would direct your custodian to transfer or roll over money to our self-directed custodian. While that is in process, our operations department will be setting up this LLC that is going to be owned by your retirement plan. And that LLC is going to be the investing entity for your retirement account. And that can be set up in the state of your choice. Once the monies are received by the custodian and your LLC is set up, then your money will move to a bank account that your LLC has access to, and the membership interest, the ownership of the LLC, will be held by the self-directed custodian. And at that point in time, you're ready to begin investing. So here you see investment number 1 is a tax lien investment. Investment number 2, you purchase property for rehab and rental. And investment 3, you actually co-own this investment with your father, your daughter, and some of your personal money. So you were co-investors at the inception of the purchase transaction. So just an idea of how you might be investing in an STC account. Now, I do want to talk briefly about non-recourse loans. This is the type, This is the type of loan that your retirement account must get if you're going to use leverage. And a non-recourse loan simply means that the security instruments, the notes, the mortgages, they allow no recourse against you, the individual account holder, or the balance in your retirement account. In the event of default or foreclosure of the property itself is the only source of repayment for this loan. There's no income or employment verification. Obviously, your retirement account doesn't have a job. It's not a person. There are some industry standards. I'll give you some general guidelines here, but of course, you will want to go out and find your non-recourse lender and find out what their particular standards, what their requirements are. Required documentation, generally a loan application, a purchase and sale contract. They'll want to see your IRA statement, and they'll probably want an appraisal on the property, and if it's a rental, a rent roll. For loan guidelines, maximum loan to value is going to be probably 70%. You're probably going to have to put down at least 30%, depending on the type of property. Maximum term could be 20 to 30 years, and we have seen some adjustable rate mortgages, so that's a possibility. The lender is likely going to look for an income to expense ratio of 1.25, and they will likely require you to hold reserves, cash reserves in your retirement account for the property, often anywhere from 3 to 6 months of expenses. So that's important to keep in mind. Eligible properties, single-family residences, some condos, 2 to 4-plex, multifamily, 5 apartment buildings, retail, office, warehouse, all of those are eligible. Ineligible properties are things like mobile homes, timeshares, condo hotels, some restaurants, residences with 5 or more acres, and farms are usually ineligible. So you'll want to keep that in mind if you're considering a real estate investment that you are going to leverage in your retirement account. Now, I do want to talk about unrelated business income tax and specifically unrelated debt financed income. So this is a subset of UBIT, and it applies, UDFI applies to any income that is generated from an asset that is purchased using financing in a retirement account. So UDFI is based on the net income of the property, not the revenue that's generated. So net income, all the revenue minus all of the expenses. And then the first $1,000 is exempt from the tax. So the percentage of taxable income is based on the ratio of debt on the property. So for example, if you purchase a property for $200,000 with $100,000 down and you finance the remaining $100,000, that means that that property is 50% debt financed. And that means that only 50% of the net income would be taxed. And so as you're paying on that loan, or as your retirement account is paying on that loan, of course, the portion that's debt financed is dropping, getting lower, and more you have more equity in that property. So if after a few years you reduce that debt to $80,000 instead of $100,000, then only 40% of the net income would be taxed. So it is based on the ratio of debt on the property. When the time comes to sell the asset, if there was any debt on that property in the past 12 months, then any gain would also be subject to UDFI. Now, at that time, that calculation changes, and the percentage is based on the debt in relation to the sales price. And that portion of the gain is taxable. So if the debt was 30% and the debt was X dollars and the sales price was another X dollars, you would use that fraction to determine the portion of gain that's taxable. So let me just carry out my last example. If you sold that property for $400,000 and the debt was down to $80,000, then $80,000 over $400,000 is 20%. 20% of the gain would be taxable. Just one other thing to note, if you own this property, this leveraged property in a solo 401k plan, UDFI does not apply in a solo 401k plan. So another benefit of that type of plan. Let me walk you through an example investment, because I have talked with some folks who say, you know, if my retirement account's going to have to pay taxes, I'm not interested in that type of investment. But sometimes you might want to consider, you know, what actually would be the financial benefit to your retirement account, even if you had to pay taxes. So let's walk through this example. Let's say it's a rental property and it's 50% debt finance, just like my last example. And you have annual net rental income of $12,000. So that's net. So all of your revenues minus all of your expenses netted you $12,000. So it turned out to be $1,000 a month, just rounding it up. Remember I said that only the portion that is debt financed is subject to UDFI, and this is 50% debt finance. So that means only 50% of the $12,000 is subject. 50% times $12,000 is $6,000. And then I also said that the first $1,000 is tax exempt. So $6,000 minus $1,000 means $5,000 of that 12 is subject to UDFI. In 2022, the trust tax rate, which is what UDFI is taxed at, is a graduated tax, and it's 10 to 37%. I did the calculation for this amount for $5,000. The UDFI taxes in 2022 would be $815. So that means your net income after UDFI is $11,185. So when you're thinking about using debt and leverage and thinking about the potential tax consequence, you may want to go through a calculation like this, and you may come to decide that $11,185 is a good return on this. and I'm going to go ahead and be willing to pay $815 in taxes. So that would be something you might want to talk to your tax accountant about and determine if that is a good opportunity for you. Now, UDFI is reported to the IRS on Form 990-T. It is taxable at that trust tax rate that I mentioned. The taxes do need to be paid by your retirement account. That's where the money went in. That's where your rental income went in. That's where that $12,000 is. So that's where your $815 needs to come from your account. And you will want to, again, discuss that with your tax advisor. Always recommended when you're dealing with something tax related. So now I am going to open the floor for Q&A. So please do type in the question box if you have some questions. And while I am pulling up the questions I got in advance, I will show you how you can contact us and get some additional information. We do have a website that has a great deal of information and also some client testimonials that talks about some of the types of investments that they have done in their self-directed accounts at stcira.com. Our corporate number is there, and my direct email is there if you'd like to send me questions or have some other things you'd like to discuss with me. So please do get in touch. All right, let me open my question box. Okay, I have just a few questions here. If you have a rental property in your account, who does the renter send their rent check to? Okay, great question. That really depends on whether or not you're using a property manager, and we do highly recommend that. They keep that distance between you and your retirement account. Typically, when the property manager collects the rent, the checks are made payable to them. They take out their fee, and then they forward a check payable to your IRA LLC to us, the excess funds. Now, if you're not using a property manager, then the checks need to be made payable to your IRA LLC, not to you. They cannot be made payable to you because you don't actually own the property. And if they can be mailed directly to our office, or if they're mailed to you, then you would just forward them on to our office. Now, I did mention the possibility of you co-owning a real estate property with your retirement account. So let's just say, for example, you personally put in 50% of the purchase price of the property, and your retirement account put in 50%. Then your renter would actually need to write 2 checks paying you personally 50% of the rent and your retirement account 50% of the rent. So we can help you understand how that all needs to be structured when you get to that point. Okay. If I want to put IRA money into a self-managed stock brokerage account, can I actively trade in that account with IRA funds? Yes, you can. You can open a brokerage account with the company of your choice. The account does need to be opened as a business account, and it's in the name of your IRA LLC. And we do request that you send us copies of your monthly statements because we need to make sure that you're not putting money directly into that account or taking withdrawals out of that account because it is a retirement account investment. So if you want to put money into it, you actually have to make a contribution into your retirement account, and then we would move the money into that brokerage account. If you wanted to take money out, you would actually have to the money would have to go to your retirement account, and then you need to take a withdrawal. So we would, again, help you with the details of that, but you certainly can do that. Okay, it looks like I have time for one more question. This is a good one. A traditional IRA requires the owner to begin withdrawals at age 72. Yes, the age 72 came about with the Secure Act in 2019, and that's called a required minimum distribution. If I own real estate in my account, am I required to sell it at some point in time to take the RMD? And if income from the property, okay, I'm going to save that question. Okay, am I required to sell it to take the RMD? No, you're not, certainly not. If you have cash in the account, that is sufficient for your RMD. You can just take out cash. Your RMD is going to be calculated on the balances of all your accounts. So if you have more than one, you might have real estate in your self-directed account. You might have stocks, bonds, assets in another type of account. You could always liquidate other assets and take the RMD from those proceeds without selling your real estate. And if real estate's the only asset that you have, you still don't have to sell it. What could be done is at the end of the year, an updated appraisal on that property so that you have the fair market value of that piece of real estate as of December 31st. And then your RMD amount, let's say it's, I don't know, $10,000. You could have the property retitled so that you personally owned $10,000 worth of that property and your retirement account owned the rest of it. So you could actually retitle the property and take the value, your RMD value of that property as your distribution. It would be taxable, but you don't have to sell the real estate. And again, we can help you understand how that's done when you have an account with us. Now, the second part of this question is if income from the property exceeds the allowable contribution, how is that handled? Okay, there's a misunderstanding here. Your contribution is set by law. So if you have a traditional IRA and you're over 50 years old, for 2022, you can contribute $7,000 from your earnings. I have a job, I get a W-2 form. Those earnings, I can contribute $7,000. Now, what your assets in your retirement account earn is unlimited. There's no limit on how much your asset can earn. So if your real estate rentals are earning, you own several properties and you're earning $40,000, $50,000 a year in rental income, there's no limit on that. The only limit is on what you're contributing from what you earned in your job or your self-employed as a sole proprietor. That is limited, your contributions, but earnings are not limited. Okay, well, I really appreciate all of you joining me tonight. If you have additional questions, please do pop me an email. I'll be happy to discuss that with you. And I hope you'll join us next month for our educational webinar. If you're interested in getting started with an STC, self-directed account, please do let me know and we can get you the paperwork and help you get set up right away. Thank you so much. I hope to see you next time. Bye.